The Federal Reserve, by keeping interest rates extremely low and trying to inflate housing and other asset prices, thought that they could ramp up the economy and basically revive the animal spirits in the housing market and create a massive wealth effect. But unfortunately, what they did instead was help inflate an echo bubble in housing by creating a massive scramble among institutional and individual investors for income. They could only get rock-bottom yields from treasuries, so they took their cash and started dogpiling into rental real estate, basically buying property and turning around and renting it to generate income the same way you would by buying a bond. Unfortunately, they got so aggressive in their bidding that they were outbidding each other for the properties that were out there, and that was driving prices much higher, faster in terms of price growth than you would expect given underlying economic growth, income growth, or job growth. It just simply didn't justify the double-digit price gains we were seeing, and now as those investors step away from the market and as interest rate pressures build, we're seeing the market slip into an echo bust phase, where prices are going to deteriorate, sales are going to deteriorate, and inventory for sale is going to ramp up sharply. The Federal Reserve hasn't really understood the housing and mortgage markets for the last several years. If you go back and look at former Chairman Ben Bernanke, you see that he called the subprime mortgage crisis contained. He said that housing prices had never fallen on a nationwide basis. And we know the Fed completely got that forecast wrong. Well, now Janet Yellen is out there saying that, yes, housing is a little disappointing, and it's something that we have to watch. But I think the Fed doesn't understand what's causing the problems out there. I believe the problems in housing go far beyond the standard economics of home ownership, higher interest rates, tighter lending standards, lackluster wage growth, and so on. I believe it's the psychology of potential buyers that's a key underappreciated reason why housing is still stuck in the mud 9 years after the peak of the real estate bubble. Many of today's potential first-time homebuyers just don't want to own a house. They saw their parents' retirement dreams collapse in the housing bust. They're buried in student loan debt. They want the flexibility that comes with renting, and they don't have the nest egg saved up to come up with down payments. The long story short, they don't want to be tied down in home ownership, and many are opting for renting, even when it might make financial sense to buy instead. Well, clearly, rent is no longer a four-letter word. People are choosing to rent more often, especially at the bottom of the real estate spectrum when it comes to first-time buyers. So even though you've seen interest rates come down a bit lately, and even though you've seen incomes and employment pick up, we're just not seeing a substantial reaction in housing. Once you take out those investor buyers, you don't have enough core buying to sustain the market at the levels that the Fed's expecting. So I would not be surprised in the least to see housing continue to struggle and continue to read about how flummoxed the Fed is of this development. I mean, they didn't have a clue that housing was going to crash in the mid-2000s, and I don't think they have a clue now why their strategies for quote-unquote fixing housing are continuing to fail. This is Mike Larson with Money and Markets. Thanks for listening.